Good morning. I'm Phil Aldrich from the Times, economics editor at the Times. I'm here to talk a little bit about Brexit, the topic of the day and every day pretty much at the moment. So today is an auspicious day. It is, of course, the day before we leave the European Union. No ifs or buts. Boris Johnson made that as clear as he could in his first speech outside 10 Downing Street on July 24th. With the supposed deadline little more than 24 hours away, I thought it was worth reminding ourselves of the Prime Minister's words. So here they are. The doubters, the doomsters, the gloomsters, they're going to get it wrong again. The people who bet against Britain are going to lose their shirts because we are going to restore trust in our democracy and we're going to fulfill the repeated promises of Parliament to the people and come out of the European Union on October the 31st. No ifs or buts. Well, in the end, there was a large if and a resounding but. Britain staggers on as a reluctant member of the European Union for the time being. Not that unlike the relationship that we've had since joining the EU in 1973, really. Our first referendum on whether to stay in the EU was in 1975, after all. The only difference this time is that we have actually got one foot out of the door. So we're not leaving tomorrow. We are leaving, possibly, or possibly not, by January the 31st next year, a full 10 months late. It's not the first Brexit deadline we've missed either. Here's a little list of the Brexit deadlines in full. Originally it was March the 29th, Theresa May's final no-deal deadline. That was the original one. April the 12th was the brief one that we had offered by the European Union, and of course that was passed. It was just a sort of standby deadline. Then they gave us till October the 31st, which of course is tomorrow. This is the no ifs or buts Boris Johnson deadline. And now we're on to the final flextension, which is January the 31st next year. And of course it could be brought forward to by a month or two if we manage to get a deal done. But given that we're going into an election on December the 12th, it doesn't look likely that we're going to be leaving before January the 31st, whatever happens. Of course, it's his fault. He would have had us crashing out tomorrow if it was not for Parliament, a Parliament that he says has outlived its usefulness, to him at least. The polls look dreadful for Labour, which is why they were refusing to let a minority government that has little chance of getting any legislation through Parliament disband, until the other opposition parties bounced them into it by agreeing to overturn the Fixed-Term Parliaments Act. That happened yesterday. And Boris was right when he said, this House cannot any longer keep this country hostage. It is a zombie parliament, unable to do anything but stagger on and slowly infect the country with its indecision. But now he has the elusive election that he desires. But the worrying thing is, an election may not change the maths enough. Then what? A second referendum to answer the Brexit question decisively? Parliament does not even want that at the moment. It voted against it in indicative votes, and even hardline Remainers like the Chancellor Philip Hammond fear the damage that a second referendum would do to democracy in this country. So Britain, in theory, could remain the walking dead for some time to come. Bizarrely, it is even conceivable that the EU will be the one that resolves this all for us. So let's say the forthcoming election on December the 12th fails to break the deadlock. And let's say Parliament fails to approve a second referendum even after we end up with another hung Parliament. So what happens then? Brussels could refuse to grant us another extension and ensure no deal arrangements are in place, which could include a massive funding package extended to Ireland, and then on January the 31st, out we go at the behest of Brussels. Emmanuel Macron is known to be fed up with the UK already, and if a comparison is needed, the Eurozone very nearly ejected Greece in 2015 from the Eurozone. After their key referendum, you can find similarities everywhere, came out decisively against the austerity package that was being demanded by Brussels of Athens. So in a no deal, it is plausible in that event that the European Union could repeat its approaches towards Greece and actually encourage, or just having got so fed up with the UK that they've decided to just let us go. But if we did have a no deal, there would still be this problem of the Irish border. But the problem would be a different problem to the one we face today. It would be a problem that urgently needed a solution. Right now, the solution is what we have, no change. The Irish border works frictionlessly. And so the problem is making the leap into a no deal or into a new arrangement. Now, we've heard a lot about no hard infrastructure at the borders, no hard border, and the EU would not put any infrastructure up for many months. It's pretty clear from the noises coming out of Brussels. And it would demand the UK agree a new set of arrangements for trade on the island of Ireland as a condition of opening free trade talks. So we wouldn't be able to talk about what our future arrangement would be with the European Union after leaving with no deal until we had basically put in place some discussions about what we were going to do about the problem on the island of Ireland, on the issue of the hard border. At that point, Boris, assuming that he is still in number 10, would have this clean Brexit, as he calls it, that he has long desired, and would be keen to start negotiations without these limitations of the Irish backstop or what he's put in place, which is the Irish Protocol, both of them to ensure that there is some form of customs union on the island of Ireland so that the trade flows smoothly. And of course, the risk is that if there is no Irish border solution, the Brussels will eventually have to put up some border infrastructure, which is, in theory, it's against the Good Friday Agreement. So we run into all sorts of problems there. Now, I don't think this will happen, but at the moment it is possibly as likely a potential outcome as any of the others, such as the election resolving this whole issue, such as a referendum being called, a second referendum being called if the election does not resolve anything. But anyway, so what is actually going on? What does Boris Johnson's deal mean? To help with that question, I thought I'd show you this horribly complicated chart. The first thing that you'll notice is that Boris Johnson's deal is not as good economically as Theresa May's deal. Now, Theresa May's deal was bad. You've got a 3.9% fall in potential. So over the long term, after 15 years, the economy will be 3.9% smaller than it would have been had we remained in the European Union. These are figures from the Department for Exiting the European Union. So this is the Brexit department. So it's Whitehall figures, and it's Whitehall estimates. You can ignore all the sort of different colorations on there, because really it's just the quantum effect that matters. And it's that triangle for the Theresa May's deal that you should look at. The Boris Johnson's deal, so she wanted a sort of close relationship with the European Union. Boris Johnson's going for a less close relationship, but he wants a comprehensive free trade agreement. So we would have had some kind of customs arrangement equivalence under Theresa May's deal. Boris Johnson's just going for a straight, more simple free trade agreement. And under that free trade agreement, you've got a sort of 4.9% to 6.7% reduction in the size of the economy after 15 years, according to these Whitehall analyses. So you end up with a slightly smaller economy, but it's only marginal, of course. Economics is not everything, of course. Brexit is all about trade-offs. Boris Johnson's deal trades off a little bit of economic performance, as you can see, for more sovereignty. And economists' scenarios are always static, as they say. They model what we know, not what might happen, not what we might become. So this is an imperfect exercise, but it is one that works well as a means of comparison, so you can see the different effects of these different outcomes. And the other thing to say is that the economy would not go into recession under these deals. These are the deals getting done. These are both Brexit deals, and we would not have a downturn. What we would have is a slowdown. The economy would grow more slowly than had we remained in the European Union, but we would still be growing, and we would still be growing reasonably strongly. Now, if there is a deal, we go into a transition period until December the 31st, 2020, which may be followed by another 2-year transition. So should we be unable to agree a free trade deal by then, we will still have this same set of rules and the same set of customs arrangements that we currently have, in theory, right through to the end of 2022. Of course, Boris Johnson does intend for us to leave the single market and the customs union. Theresa May also intended for those things, but she wanted to get some kind of partnership which allowed us to have some vague access to that. Boris Johnson's deal is much more simple in as much as it moves to a free trade agreement, so we will definitely be outside of a customs union. So after that, so come 2020, December 2020, under Boris Johnson's deal, regardless of what happens then, we are out, in theory. This is the sort of final hard deadline in essence. You've got the transition until the end of 2020, then you've got the potential for a 2-year extension to the transition until the end of 2022. So for 3 and a bit years then, to coin Theresa May's much-loved phrase, nothing has changed. In fact, life ought to get better for a while. The economy should pick up as businesses use this sort of 3 and a bit year hiatus to invest. That'll break an 18-month cycle where there has been disinvestment. Companies have been delaying their investment decisions, putting off spending because of the uncertainty caused by the not knowing what the future relationship will be. And companies are sitting on £750 billion worth of cash overall in the UK. They always have a cash pile, but the cash pile is bigger than it's ever been. So they can draw down on this, and you should see some investment spending, and that should pick up. That should cause the growth to pick up, at least temporarily. And so life should go on as normally as it did for a while, as it did between June 2016, after the referendum, and the end of last year. Which, in other words, means that we will still agonise daily over these Brexit negotiations. So in the past, we've been worrying about the withdrawal agreement and the divorce terms. In future, we're going to be worrying about, this is assuming we've agreed to leave and we are actually on the way out for a trade deal. In future, we'll be worrying about the terms of trade, that future relationship, whether we're going to have, a smooth access, how much friction there's going to be in our future trading relationships with the European Union. Will we cut more deals with America, etc.? But the economy ought to trundle along at about 1.5% GDP growth a year. There are going to be some big, important pinch points in this process, though. The first is on July the 1st next year. So again, this is assuming Boris wins the election, gets his deal through Parliament, and we are effectively, technically, we've got Brexit done, as Boris would say, in early January or by February. It's gone through Parliament. So assuming we're actually now going through the process of negotiating a free trade agreement, we've actually completed the first stage of the talks, which was just the withdrawal agreement, just the divorce, the separation, as it were. So the first key moment on this new trajectory is July the 1st, 2020. That's July the 1st next year. Now, that is the moment where he must ask for an extension to the 1-year transition period that is already in place. So on December 2020, December the 31st next year, we technically have our first no-deal moment once again. To avoid that no-deal moment, we have to ask for another 2-year transition period, get this further transition. If we don't ask for it before July the 1st, we end up, in the second half of the year, approaching a no-deal catastrophe all over again. And given that no trade deal has ever been agreed in 6 months, of this scale anyway, he will almost certainly not have struck an agreement by July the 1st, 2020. So at that point, no-deal Brexit is alive once again. As Philip Hammond has said, he fears that it will be more of a risk than it's ever been, more of a risk even than on October the 31st. And that's because under the Irish Protocol, which is Boris Johnson's proposals for replacing the Irish backstop, arrangements are in place to keep trade as frictionless as possible on the island of Ireland. Now, there will be a sort of this effective customs union between Republic of Ireland and Northern Ireland. And that removes the main impediment to a no deal today. So, you effectively have a solution for Ireland, on the island of Ireland, from this Irish protocol. That will be in place. So if we no dealed at that point, you could keep those arrangements on the island of Ireland in place. At the moment, we don't have any arrangements in Ireland which have been accepted by either side, or by both sides, and cleared Parliament. So this effectively removes one of the biggest obstacles to no deal happening, should we get the bill through Parliament. So July the 1st then, at that point onward, business is going to get very nervous about a no deal happening all over again, unless we have asked for this extension. So let's assume that an extension is agreed by the end of next year. Let's assume, even if it isn't July the 1st, at December the 30th, we say, can we please have an extension? And Brussels says, yeah, of course you can have an extension. And they give us the 2-year transition period that was in the original withdrawal agreement that Theresa May has agreed and has been carried over into the Boris Johnson agreement. So we get the transition to the end of 2022. But that's still not the end of it. First, a deal has to be agreed before that point. So you've got another 2 years to get the deal done. And second, implementation period that gives business time to switch to the new trading arrangements will be needed. So most trade deals take about 4 or 5 years, about 4 years to do on average. And then usually once the trade deal is agreed, a very complicated process, you then have a few years in which business can get ready for the new trading arrangements, the new customs arrangements, the new free trade protocols. And in that period, they'll adjust their supply chains, and there'll be all sorts of things that need to be adjusted potentially. The business needs time to switch. So when Canada did its free trade deal with the European Union, there was an implementation period after the trade deal was agreed of a couple of years. So if we don't have time to switch at the end of 2022, then the deal may feel like a no-deal Brexit to companies, even though it isn't a no-deal Brexit, because at the end of 2022, we are still working in the same framework that we are today. The transition basically maintains all of the existing arrangements. And the very next day, January the 1st, 2023, we're on these new arrangements, these new free trade arrangements, and there will be this kind of jolt in the way that business reacts to that. So we would expect to have another implementation period. So again, you could see coming up to the end of 2022, if there isn't this implementation period for businesses, there will potentially be another point of concern for companies in the UK, because they'll have to do some form of radical adjustment. So there are all these pinch points. And all this could weigh on the economy. So each time that we get close to a no deal happening again, just as has been happening in the last 6 months, you see the economy slowing, businesses stop investing, they start thinking about supply chains, and they move, opening business abroad. And this effectively will depress growth. So we'll have potentially less growth in all of these, ahead of all of these points. And the Institute for Fiscal Studies recently published a benign set of no-deal forecasts that are comparable either to a later no-deal Brexit or even this deal with no time for business to adjust at the end of 2022. Now these are, as you can see, this is their sort of set of forecasts for growth under different Brexit scenarios. Now their assumption was that we leave on October the 31st. On this. This was using the assumptions that were in place a few weeks ago. The never Brexit option there is obviously had we stayed in the European Union. That was the projection for growth over the 3 years. So significantly better than the no deal Brexit, which you can see over the 3 years we get about 1% growth overall, compared with sort of 5.5% growth for staying in the European Union. And you can see the deal, having the deal in place, this is Boris Johnson's deal, that would also be relatively strong for the economy. So there's a big cost to no deal. In fact, no deal we would technically have a small recession. We would have, you can see it sinks below, the line sinks below 100, and that means that we would actually be shrinking for a little bit. There would be a small recession for 2 years. Now that is assuming that the Bank of England cuts interest rates. It assumes that the government takes policy action, so there will be tax cuts or discretionary public spending, So there'll be the usual kind of fiscal stimulus. So there would be some efforts taken by government to make sure that the economy was stabilised to some degree. So that even with some assumptions there, you still have a small, shallow recession. So where would that put us in terms of other recessions? So here we are. This is quarterly growth, GDP growth going back 20, 30 years. You can see the Great Recession, which we had a decade ago, was pretty nasty. We shrank in one over a series of quarters quite significantly. It took us a while to get back to growth. There's really been nothing equivalent to the potential shallow recession that we would face under no deal until you go back to that and the 1990s recession. So this would effectively be the second or third worst economic event of the last 30 years. Now, the government has plans for a no-deal Brexit. The biggest one of these plans is for there to be zero tariffs on 88% of UK imports for 1 year. And this would effectively is being designed to prevent costs spiraling for households. You can imagine on agricultural goods, as food comes into the UK, if you put up tariffs which match some of the European tariffs, like 20% on some foodstuffs, you would have enormous inflation in the shops. You'd also be seeing, because the pound would be falling, as we've seen, at the point that we left, at the point that a referendum result came out, we had a big sort of 20% fall in the pound. You would have a fall in the pound again. You would expect in a no-deal Brexit. So you'll have this inflation from the weak pound, and you'll also have this inflation from the tariffs being imposed on lots of stuff. So the government has decided not to put the tariffs on because it doesn't want to hit households with massive extra costs, because that will make any slowdown or recession significantly worse. So that's their thinking about why there would be this 1 year zero tariff arrangement. There will also be targeted policy responses. So for businesses, if businesses that are facing cash flow problems, none of these policies are guaranteed, but they're certainly the things that Treasury are thinking about. There will be sort of credit support schemes for companies facing cash flow problems. So you can imagine in a supply chain, a small automotive or small engineer which supplies component parts to a big company like Jaguar Land Rover, they may not be paid on time. They may have cash flow problems. So the government is expected to provide some kind of cash flow or credit guarantee scheme or credit support scheme to make sure that companies that are viable don't go bust just because of kind of cash seizures in the system on the supply chain. That would be one thing they could do. There would be financial injections into sectors that need help. Again, we talk about car industry, so you could imagine specific public taxpayer money going into specific industry that need help. We had a car scrappage scheme back in the Great Recession to get people to trade in their old cars, their old bangers, get some new ones. Again, it just keeps demand going for cars and keeps the car plants busy and jobs maintained. So that kind of stuff. Then we would see, possibly on the other side, we see VAT cut, or as again happened in the recession, temporary VAT cut. There could be income tax tax cut for households. There may be employment support incentives. This is something which the government has been thinking about as well. So companies will be effectively paid to take people on. And we would not expect the bank to raise rates. But it's all going to be expensive. This is, again, the Institute for Fiscal Studies and their forecast for what would happen to the public finances. This is borrowing. You can see in the worst year, 2021 and 2022, that financial year, you look at the light green bar chart on the right, it shoots up to about 4.5%. The most recent numbers that we've got for the size of the deficit in the UK is 1.1% of GDP, which is basically that says that we've got our public finances under control after 10 years of austerity. And this would push our public finances back into deficit to 4.5%. So we would basically be unwinding 5 years of the austerity and the cuts that we had in the space of 2 years to deal with a no-deal Brexit. So it would be quite damaging for our public finances. So fiscal action will be expensive. The fact is actually this isn't even quite a fair comparison. In 2014, to fix the problem, so once we take on all this extra borrowing to fix the problem, because our economy would be growing more slowly than it did back in the post-crisis days, because we have now downgraded our potential growth. The UK can't grow as fast as it used to, is the new assumption. It would actually take even more austerity to get back to where we were. So we had a deficit of about 4.5% in 2014. It would take us longer to cut to eliminate that than it would have done in 2014 when the economy was actually stronger. And also, I mentioned the effect of any Brexit decision, a no-deal Brexit, on the pound. We've already seen two big devaluations. One was after the Great Recession in 2008, where we had a 25% fall, and the other was after the referendum, where we had a 20% fall in the pound. Most economists are expecting a no-deal Brexit would cause another 10 to 15% fall in sterling, at least temporarily. So you would see the same loss of value in the pound. It would be more expensive to go on holidays overseas. It's going to be more expensive to import stuff in sterling. So there will be this hit. It may work its way out over a few years, but certainly in the short term, there will be a big sort of sterling crunch for importers in the UK. So that would drive up inflation, and it would hit take-home pay. It would cause living standards to decline, and there's also an effect on jobs. We've got a lot of UK jobs linked to EU trade. The manufacturing and services sector are the biggest employers of EU-linked jobs. Not all of these will be not all of these will be lost, but there's 3.3 million which are thought to be at risk from leaving the EU, and these are some of the jobs. The jobs that are linked to EU trade by region. So you can see, you've got. In London's got the largest amount of jobs. This is because of the financial services industry. But you can see also in the Midlands, there's quite a significant number of jobs in the Northwest, all linked to EU trade. This is a sort of manufacturing heartlands. So there are regional risks for the UK if we leave the European Union without a deal and it actually starts to hit our industrial heartlands. This again is the Brexit department's analysis of the industry, the sectors that will be hardest hit. So they again think manufacturing will be particularly hard hit by the no-deal Brexit. And here this is a sort of a deeper breakdown, but you can see motor vehicles on the far left. On the far right, you can see chemicals, pharmaceuticals. So sort of manufacturing. High-value manufacturing stuff is going to be damaged. Cars, car components, chemicals, pharmaceuticals. Those are the things that the government anticipates will be hard hit. So all of this is really to set the scene for what promises to be a very difficult period for business, particularly those that trade with the European Union. So when the Brexit campaign was being run in 2016, one of the arguments often made by Vote Leave was that leaving the European Union would release business from red tape. So regulations would be pared back. That was the thinking. And we got a quote from Graham MacDonald, the chief executive of JCB in 2015. What is needed is a lot less red tape. Some of it is costly for us and quite frankly ridiculous. Whether that means negotiating or exiting the EU, I don't think it can carry on as it is. So this was when David Cameron was doing his negotiations. It's a burden. It's easier selling to North America than to Europe sometimes. So there is this sense. There was definitely this sense in the talks that there was going to be this sort of freedom, this liberation from all the this Brussels red tape. But the fact is that Brexit is actually going to end up tying business up in red tape, certainly for a while. There will be customs requirements, migration rules, and data regulations. All of these are going to cause significant burdens on business. Let's start with trade. So HMRC estimates that there are 250,000 companies in the UK that trade solely with the EU. For the first time, they will need economic operators registration and identification numbers. That's AORI numbers. And HMRC says 150,000 of these companies that that actually do export, but have never had to comply with any kind of export customs arrangements or export tariffs or any of the complications of export, because they're just doing it within the single market, the European single market. The HMRC says 150,000 of these companies have been auto-enrolled, so they've got their AORI numbers. Now, they found them because these companies are VAT registered, and therefore they are identifiable. But there are 100,000 who are not VAT registered, so they're smaller companies, obviously. 20,000 of those apparently have been found. And they've been issued with AORI numbers, but there's still 80,000 companies out there, in theory, that haven't got these AORI numbers. And AORI numbers are quite important. So getting an AORI number grants a company transitional simplified procedures, which ensures that goods are released before full customs declarations or payments are made. So, and VAT, and before VAT has to be paid. So all of the obligations that you have as a trader to, pay your tariffs and and make sure that the customs declarations are clear, pay your VAT before you can take, before the good can be taken across the border and just put into the supply chain or put into the shops or wherever it's going. These AORI numbers allow that process to just be speeded up, basically. Now, it takes a working week for HMRC to issue an AORI number, and the taxman is recommending companies, particularly smaller ones, use a customs agent to also speed up this process. So you just take on, you employ a customs agent to manage the cost of, or to manage the complication of, filling in all of these forms, making sure that they go to the right places, getting all the sort of technicalities of this administration correct. So all of these forms are going to have to be filled in if there is no deal. But it's not cheap to take a customs agent on, and it's not cheap just filling in these forms. So the HMRC estimates that every customs declaration form costs £15, between £15 and £56 in sort of administrative burden to businesses to fill in and to organise. And agent fees can be charged on top of that. Further agent fees can be charged on top of that if you have a customs agent. So in total, its estimate of the cost to both UK and EU traders of having to fill in these forms, just sorting out these custom declarations, import and export declarations, because each time you do any cross-border trade, you've got to fill in both the import and the export declaration. So the cost here is £15 billion a year. That's what HMRC reckons. Now, half of that will be borne in the UK by UK companies. The other half is roughly, anyway, is all the European companies that are exporting into the UK or importing out of the UK. So to be clear, this is not an economic cost. It doesn't show up on the GDP numbers because I guess a lot of that money stays in the UK. It'll create jobs in the custom agents and it'll create jobs at HMRC. But it is a straightforward cost on business by making them fill in all this paperwork and having to pay an intermediary. So it's a friction in the operation of doing business, and it is effectively the definition of red tape. It is exactly these regulations that Mr. McDonnell was saying that we don't want to have after Brexit. And many of those hardest hit companies will be small companies who are really unprepared for all this because they've never had to deal with it. Now, there was a piece of work by Oliver Wyman as a consultancy firm which showed that 65,000 small UK exporters, that's firms with less than 50 staff, trade solely with the EU. So some of them, these are relatively small companies that 65,000 of them that will suddenly be facing this new administrative burden. And some of them may not bother if the cost burden is too high. So they could be like changing their entire business plans and their strategies. And of course, none of this includes the cost of tariffs. So the EU will raise barriers from day one. It has to under global trading rules. It has to put up these tariffs against UK businesses. It has no alternative, because we will be outside the European Union. The tariffs that they apply to all countries outside the European Union will then just simply automatically be applied to us. And some of them are very expensive. So there's a lot of protections in Europe for agricultural goods. There's a lot of protections in the European Union for cars. So we'll be hit with tariffs on anything we export to the European Union for cars and agricultural goods, to name a couple of. These are double-digit tariffs of 10% of the price and more. So they'll make our exports less competitive and no doubt reduce demand from anything that we're selling into the European Union. Goods coming the other way, however, as I was saying earlier, will be largely tariff-free. As the UK gets to set its own tariff schedule, once it's outside the EU, any country it doesn't have a free trade deal with, which, as all of our free trade deals are through the European Union, we don't have any other free trade deals, so we will have no free trade deals on day one. So as we get to set our own tariff schedule, we can do as we choose. So in that first year of Brexit, of a no-deal Brexit, that will mean keeping tariffs at zero for 88% of all imports. We currently have zero tariffs on 82% of imports. So the reason why it goes up is that we're going to increase the number of goods that are going to be zero tariffed, including some which currently do have a tariff on them. And so more foreign imports, so outside the EU, will be able to get into the UK tariff-free. So it's a trade liberalisation of sorts. We'll effectively be easier to export to as a nation than we were as a member of the European Union. So that's goods coming into the UK. So it will feel the complete opposite for goods going outside of the UK, certainly at the beginning, where all of our goods going outside the UK, particularly 45% of our trade is with the European Union, those goods will start to incur, a lot of those goods will start to incur tariffs. So it'll become expensive for exporters. So it's going to change the sort of competitive and economic makeup of the country. So this tariff schedule is intended, so our tariff schedule, this zero tariffs on 88% of everything we import, is designed to keep prices down for consumers. But there will be some protections for UK industry too. So reason why it's not on 100%, zero tariffs are not on 100% of goods, is because some industries, the car industry, for example, is going to face 10% tariffs when they export to the European Union. We don't want European Union cars coming into the UK, finished European Union cars coming into the UK tariff-free, and thereby undercutting or competing with our domestically made cars. So we want to make sure that we maintain a market for our domestically made goods, keep it as competitive as possible here for us, given that the markets overseas that we've been selling into will be less competitive for our companies. Then there is the Dover problem. So this chart shows that of our trade with the European Union, Dover accounts for nearly a quarter of everything. So roughly 22% of UK trade with the EU comes in and goes out through Dover. So both Dover and Calais. So this is going to potentially be a pinch point, and people have been worried about tailbacks and delays at the border. And both Dover and Calais say they are prepared for delays. They are prepared for a no-deal Brexit, but delays are inevitable. Operation Yellowhammer, which was the government's document setting out the worst-case scenario and what they expected in the worst-case scenario, what they expected could happen, anticipated that you could get delays of up to 2.5 days at this border, at the Brexit-Calais border, if there's a no-deal Brexit. This is ferries crossing over, having to wait on one side for ages as all the trucks slowly get off and have to go through technical and complicated procedures, and then the ferries come back to the other side, load up and come back to the other side again. On our side, we'll have long delays as the customs checks are done. And so this will cause enormous tailbacks. And so you have the M20 turning to a car park, all these fears. Now, both Dover and Calais insist that they are prepared now. So hauliers have been green-lighted under no-deal contingency plans, so both sides will continue to operate. It will be as smooth as possible. These hauliers will have to get a community license to get this kind of preferential treatment, rather than just having to stop and be checked as thoroughly as would be expected if we just fell back onto no-deal arrangements. So these no-deal transitional arrangements are only in place until the end of this year, though, so only a few more months. But they are provisionally expected to be extended until next July. You would expect them to be extended again beyond that. But again, there is, because of the Brexit delays that we saw at the start of my talk, we've used up a lot of the time that was given over to these contingency periods. So the scale of the throughput at Dover makes it such a key artery for both the UK and the EU that it is almost certain to ensure that the transitional arrangements are extended, so beyond July, and to July at first and then beyond July. But obviously relations between Brussels and Westminster need to remain positive. And blockages cannot be ruled out. There's the Operation Yellowhammer 2.5 day delay, unlikely, but you could imagine a scenario which would be not unlike 2015 when we had Operation Stack. Calais went on strike, and there was 4-hour delays across at Dover as the lorries backed up along the M20 because they couldn't get across. At the Irish border, customs, tariffs and VAT will be done behind the border. We don't want to have, this is no deal again, we don't want to have border infrastructure, so we're basically going to do everything as much as possible behind the border for as long as possible. European Union will not put up infrastructure for as long as it can, hoping that there will be some kind of arrangement put in place, some kind of temporary customs arrangement like the Irish Protocol that Boris Johnson has already proposed, and then we can begin those free trade talks. So goods that are, but the basics are that the goods that are travelling from Northern Ireland through the Republic of Ireland, but back into Britain, they will not incur any duty. So they will just be seen as a sort of a road corridor towards the internal market of the United Kingdom. Otherwise, traders in Ireland will need an AORI number. They'll have to pay VAT, they'll have to do excise duty, tariffs, and they'll make their import and export declarations. So there will be a whole lot of electronic paperwork to be done for everything done between the Northern Ireland and Republic of Ireland across that border. So again, more frictions, more complications for business, more cost for business to do this. And immigration also threatens to become a cost for business. You can see since the referendum, EU migration has tumbled. You've got core shortage occupations like nursing, how they've had to be filled from further afield, which has driven up non-EU migrations. You can see the green line there. It's rocketed since Brexit, since the Brexit vote, and the EU migration numbers have been tumbling. So it's not quite clear yet exactly what the migration regime will be after Brexit, after we do sign the withdrawal agreement deal and actually move on to the new stage of process towards our future relationship. There is one policy working its way through Parliament very slowly, and that was the one that was devised by Theresa May. And there is another in train, which is the Australian points-style system, the Australian-style point system, which is the one that Boris Johnson prefers. Theresa May, her plan was to let in highly skilled and skilled workers from all countries, not just the EU, for jobs that commanded a £30,000 salary and above. The plan is to stop cheap foreign labour undercutting UK workers. As the government's Migration Advisory Committee said, employers should not be using migrant labour to put downward pressure on wages where there is a ready supply of labour. So if you've got the workers in the UK, employ the people in the UK. That's the sort of principle behind Theresa May's migration regime, which a lot of that will be absorbed by Boris Johnson. So the Migration Advisory Committee is aware that this will add further to red tape for businesses. The new system will need to be accessible to the large number of businesses, particularly smaller ones, that have previously been able to hire migrant labour from the EU without needing to engage with the existing sponsorship requirements. Therefore, we will need to make the system as straightforward and light touch as possible and low cost to employers. So they're obviously very aware that this is going to be a costly problem for business. So there will be exceptions to the £30,000 cap on migrants coming to work in the UK. This is a £30,000 baseline. You've got to earn at least £30,000 to qualify for a work permit. So, but at the moment, those exceptions, those different jobs in those different industries where they say you can earn below that, they only cover 9% of the total employment in the UK. So it's a fairly limited number of exceptions. So for some industries, it will mean that all 100% of EU employees who would not qualify for a UK work permit were they to apply after the regime changes. So at the moment, so here we have, among these industries are the process plants and machine operatives, where a relatively large share of employees within the occupation currently earn below £30,000, the Migration Advisory Committee says. So that's the column with the blue arrow. So in the industry, in the plant hire industry, the assumption is, or certainly the numbers suggest, that most of the EU labour that works in this industry in the UK is being paid less than £30,000, almost all of it, in fact. And so if those people came to the UK today and wanted to get a job, they would not qualify, which would mean that plant hire industry and others here, you've got elementary occupations, these are sort of primary school stuff, and care homes, although care home workers are, some of those are in the special exemption occupations. But you have specific industries where so many of the foreign staff who work in the UK fall below the £30,000 cap that it would completely transform the arrangements for businesses in the UK. They will have to employ local workers, and that may push their wage bill up. Staff who are already here can stay. So the people who are already here don't have to leave the UK. So all of these guys who are on less than £30,000 and working in the plant hire industry, for example, all these European Union nationals, they can stay in the UK. Those who have been here for 5 years before the no-deal Brexit date, or 5 years before December 2020, so even if there is a deal, the deadline is December 2020, you have to have been here for 5 years by then to qualify for settled status. So then these migrant labour these workers will be able to stay in the UK without any problems. And if they've not been here for 5 years, you can apply for pre-settled status. And once those 5 years have been reached, you can get settled status. So again, there shouldn't be, there are administrative burdens. You've got to check your workforce and qualify for this, for settled and pre-settled status, and make sure that you've got them officially registered. So an Australian-style point system would be different. Boris Johnson has a liberal streak in him, and his plans would be expected to see the borders opened up further. He wants to scrap the 100,000 migration target that became David Cameron's burden. And a point system would work by giving more points to desirable sectors, so those highly skilled or where there are shortages in labour supply. So there will be, in theory, Boris Johnson will make it easier for employers to get the staff that they need. Again, as the previous chart showed, it's going to look increasingly like non-EU labour is going to fill the gap here. But it could be from anywhere, because there'll be no favouritism or bias towards EU workers. Qualifications, they're another thing. So under a points-based system, how do you get your points? If you've got strong qualifications, you get more points. If you're younger, in Australia, if you're younger, you get more points just by dint of being younger. Education counts, so if you've got good A-levels or you've gone on to do a PhD, these kind of things will give you more points. And obviously, if you work in industries which have been selected as we want people, we want nurses, we want care workers, we want artificial intelligence programmers. We want these guys, there will be more points allotted to those industries so you can get those people in. And so taking back control of the borders does mean the government can decide which industries qualify for the migrant labour and which don't. So, this can change. It will make the most of sovereignty. We will introduce flexibility. So rules can change from one year to the next. We can choose which shortage occupations we need. That could be something to do with the government's industrial strategy. If we want to have more engineers, we can choose to make the point system favourable to engineers. If we want more plant hire people, then we could have a more generous point system in the plant hire industry. The other issue, data compliance, after Brexit, that's going to add significant red tape as well. If there is no deal, there are arrangements in place to keep data flowing between the UK and European Union. So if there is a deal, there are these arrangements in place, which will basically be more or less the same as what we already have. But if there's no deal, if there isn't a deal, companies will have to take a variety of actions to comply with the law. And for big businesses, this is going to be bread and butter stuff. They have to do it already. They're going to be trading. They'll be taking data from outside the European Union, and so they'll have their legal departments which will know all about how to manage that process. But for smaller companies, it could cause problems. Again, these are smaller companies, the 65,000, for example, who trade exclusively with the European Union, or the 250,000 that trade exclusively with the EU, including larger companies. Those companies could have more problems. So right now, data can flow freely across the EU as long as companies conform to the General Data Protection Regulation. And as GDPR is being incorporated into UK law, there should be no real change after Brexit, as long as we leave with a deal. If there is no deal, the UK will be treated as an external country, needing an adequacy ruling which will show our data protection standards are up to scratch. And the European Commission has indicated that it would not be in a hurry to give us this adequacy ruling. They can kind of hold us hostage. And if you're in free trade talks, it's kind of useful to have leverage. So they may delay it. They may hold back on these things which would make the flow of data just that much easier, particularly for smaller companies. Most of the data protection rules affecting small to medium-sized businesses and organizations will stay the same. So, for example, for companies that already comply with GDPR and have no contacts or customers in the EEA, the European Economic Area, there is little to do to prepare for data protection compliance after Brexit. But companies that do receive personal data from their contacts in the EEA, they will need to take extra steps to ensure that the data can continue to flow after Brexit. So sending data to the EU will supposedly not be a problem. We, as a UK company, we can send our data to a EU a third party because the UK has decided that it is happy with European standards. Makes sense. We're incorporating GDPR rules into our law. We already apply GDPR rules, so we will accept that the GDPR rules are good enough for us. So there's not going to be any additional burden that way. But companies that receive data, such as names and addresses of customers, from a company in the EU or the wider European Economic Area will need to take action because the European Union are not going to be happy enough to say that our new set of GDPR rules, even though to begin with they'll just be a complete reflection of their rules, they'll not be happy that we can adjust those and we can sort of relax standards. So they want to make sure that any data coming across to us will be compliant with their rules, not just our rules. So that introduces some new complications for small businesses. Companies with an office, branch, or other established presence in the EEA or with customers in the EEA will need to comply with both UK and EU data protection regulations after Brexit. They may be best off designating a representative in the EEA. That's certainly what the Information Commissioner's Office says. So, again, a potential cost here. You've got to go out and find someone as a representative in the EEA area to manage your data protection when you're transferring So when you're bringing data across from Europe into the UK. Small companies that receive data from the EU will need to draw up a contract with the data provider as well. So, and the most straightforward way of doing that is using EU rules, and these are called standard contractual clauses. So you'll have to get this designated representative to manage this process for you through these standard contractual clauses. But identifying whether your company needs to sign an SCC is a minefield. So the Information Commissioner's Office has these kind of examples to help give you work through it. So if you're a hotel in Cornwall that takes direct bookings from individuals across the EEA, including names and addresses and other personal information, and sends the information directly back to them, that's fine. It's okay if you take, if the transfer is, neither transfer is restricted under GDPR rules because it is made directly with the consumer, so the consumer to business. So there's no business to business, there's no third party involved here. But if this hotel in Cornwall uses a cloud IT provider, such as Amazon Web Services or something, which stores and processes their data anywhere outside the UK, so if it's sort of a big data warehouse, it's big cloud computing facility is not in the UK, then even though the customer data is effectively direct to the Cornish hotel, because the data is being stored somewhere else, you're going to have to make sure that you get a standard contractual clause. So this would equally apply to a hairdresser in Cheshire, even if it solely has a British client base. If it uses a cloud-based service provider and the data is being held overseas, then you could end up needing to get these special contractual clauses again. So as you can see, it is a potential minefield. This is so fiddly and technical. And companies are supposed to review your contracts and, where absent, include standard contractual clauses or other alternative mechanisms to transfer mechanisms to ensure that you can continue to legally receive personal data from the EU or the EEA. That's, again, the Information Commissioner's Office. And apparently, the ICO says, for most organisations, especially small businesses, taking the required action isn't highly costly and doesn't always require specialist advice. Now, that advice reminds me a little bit of the no ifs or buts. It says it isn't highly costly and doesn't always require specialist advice. That does sound a little bit like suggesting that companies ought to check, and it probably will be rather expensive. So no ifs or buts. Well, we know what happened there, and it does sound rather familiar. If I were to sum up my points here in a simple, sort of pithy phrase, I'd say that what I'm getting at is that Brexit is expensive. It will cost us economically. It will cost us, and it has already cost us, an estimated 50 billion in foregone growth over the past 3.5 years. We've lost about 2.5% of GDP compared with what our growth would have been had we not voted to leave the European Union. That's just purely mechanical through the loss of business investment, which has fallen way below where it would otherwise have been and what other countries have seen, the business investment levels that other countries have seen, and that's caused by the Brexit uncertainty. So our economy is 2.1 trillion. That's the size of the economy, 2.1 trillion pounds. We've lost about 50 billion pounds. It's not huge in the grand scale of things, but it's not good. It's an opportunity cost, and it has also cost business. So Brexit has also cost business in lost opportunities as they spend on money on Brexit preparations, and they delay their investment decisions. And it's going to ultimately cost business in red tape, as I've been running through, from the trade, the customs arrangements, to the data protection stuff, to new immigration requirements. There's going to be all sorts of administrative burdens, and we're not even there yet. We still haven't got Brexit. We've got an election. There are a lot of moving parts in the economy at the moment. Will there be a deal? Who will win the election? When will the election be held? Well, we've got that answered finally. What on earth is happening to our normally sensible and pragmatic country? There is much to worry about, if there is no deal, and even if there is a deal, some no deal fears will linger. As I was explaining, there are these pinch points, these points at which no deal becomes an issue once again. And right now in the markets, the uncertainty is palpable. Mark Carney, the governor of the Bank of England, recently compared the pound to an emerging market currency because it is so volatile. And certainly the VIX, which is the volatility index in the markets on how much the pound is going up and down, that suggests sterling is more of an emerging market currency than the Turkish lira at the moment. A few years ago, shortly after Brexit and Donald Trump's victory, I was at Davos speaking to business leaders who were generally in a state of stunned denial. And they were waiting for the clouds to clear to let things settle. The following year, I saw them again. This time, their ideas had changed. They decided they had to just get on with expanding and investing in their companies. But the political uncertainty, they decided, was simply the new state of doing business. And like Brexit, that uncertainty is not going away. And we're just going to have to learn to live with it. Thanks very much.
Very much for the speaking and presentation. You mentioned there will be a transition period. This transition period will be started just after when there is no deal, or the other day will start it, or the government will announce that this transition period will be started.
So the transition period is actually in a deal. There would be no transition in no deal. So in a deal, you get the transition period, which starts on the day that the deal is signed, and you then have this period where we can begin the negotiations for trade talks, a new free trade agreement. The transition period technically ends on December the 31st, 2020, but it can be extended for 2 years until December the 31st, 2022. If there's no deal, then there is no transition. But both the UK and the EU have put in place contingency plans. And so some of those contingency plans were the things I was talking about. So sort of special green lighting for hauliers, so lorries, trucks going across Dover to Calais, they've been given special permissions. The fact that customs checks will be done on board ferries, for example. The fact that there's been large acreage put aside in Calais for lorries to move into to do the brief customs check procedure. There's been beefing up in numbers. Calais have been doing a huge number of new customs officials, and we've done very similar things over here in the UK. Other things which would be, again, contingency plans are, for a no-deal Brexit, are the zero tariffs for 1 year. That would be, again, that's another one of the no-deal contingency plans. So it's not technically a transition, but it's just to make the shock of no-deal Brexit less severe rather than transition.
Just want another question. You said no tariff. In this case, these no or zero tariffs will be applied to all countries or just European Union countries?
Yeah, so they will be applied to all countries. The way that the tariff system works is that you have to have a set of rules for all the countries that you don't have. This is under World Trade Organization. So one set of rules for all the countries that you don't have free trade deals with. And because when we leave the European Union, we will have no free trade deals at all on day one, because all our free trade deals are through the European Union. So on that day, we will effectively have to have our own tariff schedule, so we can set our tariffs from that day onwards. And so these tariffs, so this zero tariffs, will apply to all countries in the European Union. So this is zero tariffs on 88% of imports into the UK. Will apply to all countries in the European Union, and it will apply to all countries outside the European Union, whether that's America, whether it's Australia or Africa. There are 50 trade deals that we have through the European Union with countries like Switzerland, and actually we have rolled over and have been given guarantees that I think something like 13 of those are going to be rolled over, and we will have those free trade deals with those particular countries. But it's a very small proportion of our overall trade. The vast majority of our trade is with the European Union, 45%, and the second biggest market is America. So these are effectively, really, these new tariffs will be the arrangements for our trading with everyone in the world to a large degree on the point of leaving with no deal. So,
this period, do you think how long it takes to a new agreement with the European Union?
Yeah, so I mentioned the average time it takes to agree a free trade deal is 4 years. And then you take another couple of years to implement free trade, to implement the terms of the free trade deal for businesses. So it's a complicated process. So it can, in theory, it may take us 6 years from the moment that the withdrawal agreement is signed to actually have a fully operational free trade deal in place with the European Union. So we haven't signed that withdrawal agreement yet. Parliament has indicated that it will approve that withdrawal agreement. That's Boris Johnson's deal. If after an election, we do have that official vote, and we do get the Parliament to approve the deal. The European Union have accepted that deal. So if Parliament approves it, then we're through that first hurdle, and then we go on to just negotiating the free trade deal. So from that point, let's call that January the 31st. Yes, so that's when the current no deal deadline is. So let's say from January the 31st next year, we start that process of the free trade deal talks. That if you look at past averages, it'll take 4 years to agree the talks, and then 2 years to provide some transitional period for businesses to adjust. And of course, this is the whole point that why no deal still becomes an issue, because on December 2020, we could still we could decide not to ask for a transition extension. So if we have not agreed a trade deal by then, we end up crashing out on that date, because that's the date that we're, technically again, that we would be leaving. So there are these hurdles, and certainly at the moment, the way that it is structured, a normal free trade deal will take longer than the amount of time allocated by Brussels and by Westminster to deliver the free trade deal. Because even in the best case scenario, we have until December 31st, 2022 to do everything. So 3 years instead of 6 years.
Just ask a question. You said it is zero tariffs, nearly 88% of the goods would be included in the zero tariffs.
Yeah.
Is there any, for example, how we can be sure the goods who are important is in this 88% or not?
Yeah.
And is there any list of tariffs the government announced? These goods, if there is no deal, these goods can be important with zero tariffs.
Yeah, there is a list. There is a list. They have produced a list of goods. I mean, there are so many sort of sub-products. So, for example, there are 5 different categories of butter. There are many different products, and you have to check the list. And I can't remember how many total different sort of product codes there are, but something like 9,000. And so you'll have to check on the HM Revenue and Customs website. They have, I think that's where they have the full list. And so if you're a trader who's importing into the UK, you'll know that the goods that you're importing, they'll have a SIC code. So they'll have a particular product code, and you have to check that product code against in HMRC, and you'll be able to see there whether your product will qualify, has been designated a zero tariff product, or whether it will be subject to new tariffs once, because if your company is in Turkey, then at the moment, obviously, it's zero tariffs because it's in the customs union. But from the no-deal Brexit day, there will be tariffs on your goods potentially if they are not within that 88%. And you know the whole point. If you're, I mean, a sort of shorthand to work out whether your goods would be likely to be zero tariffed would be to establish whether if all of your competitors are foreigners, so foreign companies, if all of your competition is basically importing their goods into the UK, it's more likely that that will get zero tariff, because the principle is that you want to, the tariffs will go up on areas in industry where we have UK industry where we don't want to hurt the UK industry, but we don't want to hit massive new cost into the UK either. So if there isn't a really big industry in whatever your company does, then, and most of your competitive products are also imported, it's probably likely that yours will have been designated for zero tariffs. I mean, an example for an industry which that won't apply to is the sort of potteries, the ceramic industry, which they've managed to have tariffs imposed on imports so that the UK potteries, ceramics industry will be protected from competition, so it will be help that industry. The car industry, so the finished cars was another one I mentioned, that will have import tariffs imposed on any cars imported from Germany, for example, because that will make sure that we buy the cars that are built in the UK to make sure that the factories in the UK stay open and the jobs in the UK are maintained.
Okay, so the deal that's on the table at the moment, why is it that MPs weren't happy to vote for that deal? Is it because economically it's not good for the country, or is it because they don't want to vote for a deal and see Brexit happen?
Well, it's a political question. I mean, so the deal, they did actually vote for the deal, but what they didn't vote for was the timetable, the schedule to push it through Parliament. So what kind of happened was that is that MPs decided that they would back Boris's deal to show that they were, getting on with Brexit. But then they planned to introduce amendments to the deal. So the deal would then be subject to a second referendum, for example. So if you get that put in legally, you can't do the deal without first putting it back into a people's vote. So they wanted to do things like that. I mean, there were the more extreme versions of the amendments that they wanted to put on the deal was Labour, for example, they talked about amending a customs union. So wanted to make sure that as part of the deal, we had to remain part of the customs union, European customs union, which would fundamentally change the deal. And of course, so the reason why the MPs voted in favour of the deal was so that they could then change it. And that was why Boris Johnson didn't want to have very long on his schedule for debating the deal, because there would be all sorts of changes that would be introduced. And once it changed, the sort of hardline Brexiteers in the Tory party and others would have changed their opinion. They would have said, no, I'm not having a second referendum, or I'm not having a customs union as part of this deal. So then they would have voted against it. And so then the deal would have failed. So that's the kind of politics that was going on there, which is why we've kind of ended up in the election instead, because the ambition is to get, I mean, obviously Boris Johnson's ambition is to get a large enough majority getting in control of Parliament without having to have the DUP on side. A manifesto which stands on a platform of his deal that he's signed, which would mean that the entire Tory party should back. Every MP has stood on a manifesto with that in it. Then they would, in theory, vote for the deal when it's put back on the table. So if you have a majority Tory party and you have a manifesto which has kind of committed every Tory MP to back his deal, you can then push his deal through Parliament without any amendments. And then we get, we move forward. But I mean, the objection by a lot of the Tories, the sort of Remainer Tories, was that it doesn't remove no deal from the table. Like I was saying, we still have a no deal pinch point in July next year in terms of if we do not ask for a transition extension, come December next year, we're out. And there's no way on earth that we're going to get a free trade deal signed with the European Union in the space of 12 months. It's a really complicated thing to do. It's never been done on that scale within 12 months.
So why do you think a transition hasn't been written into the deal?
Well, the transition is written into the deal because it's basically, they've just imported most of Theresa May's stuff, but they've made certain changes such as the Irish backstop. So in Theresa May's deal, the transition ended on December the 31st, 2020. Of course, under Theresa May's deal, we left on March the 29th, 2019. So we had 21 months, I think, of transition. Now, it then said, if you need longer, you have to apply for a 2-year transition extension on July the 1st, by July the 1st, 2020. So those clauses have been kept in Boris Johnson's deal. So we still have a transition, but Theresa May was clearly much less. She didn't want to do a no deal, and Boris Johnson's much firmer that he is willing to take a no deal seriously. So it means that it's much more likely that if free trade talks are going wrong, he won't ask for an extension to the transition period to basically make the threat of no deal alive once again as part of the free trade talks, as part of leverage in those free trade talks, which will basically put us back into this kind of Walking Dead sort of situation that we've been in for the last, since March the 29th, where we technically should have left. We have this rolling deadline, rolling no deal risk. So we'll technically be back in the same place. But of course, Theresa May's deal also, even beyond December the 31st, 2022, we then would have gone into the Irish backstop, which was again a kind of another version of the transition period, but it was one that was unlimited and unending, and this was why it became undemocratic and made us sort of a vassal state and all that kind of stuff. So under Boris's deal, we don't have a backstop, so actually there is a much harder deadline on December the 31st, 2022 than under Theresa May's deal. So that was another thing that's altered. But there is potentially this transition, but again, it's unlikely to be long enough, even by the end of 2022.